Hey everyone, welcome to Retire with Style. Alex here, and we're continuing our conversation with Ryan Walter. Hey Walter, how are you?
Hey, I'm doing great, Alex. How are you?
Nice, nice. So what's changed since the last time we've spoken?
Yeah, not a whole lot. Not even my shirt.
No, well, I did get a cup of coffee, so there is
Yeah.
that. But today we're doing the unthinkable. No one has the guts, but we stand up and we will do this. Effectively, we are going to review our firm's ADV. What do you think? Is that are we stop the insanity?
Yeah, the most common thing I hear from the advisors I work with is why do we have to have this document? Nobody ever reads it. But I think as we go through this, you're gonna find like there's a lot of really
Yeah,
important,
yeah, yeah.
useful information in there. So people who aren't reading it, you should read this. It's gonna give you a ton of insight to the people you're working with.
No, I agree. And again, the theme here is like the business of advice, simply because we know full well that majority of our listeners are consumers, and the reality is we've gotten questions about you know engaging with an advisor or someone that's with an advisor, and they're asking us questions that are like business related, if you will. And one of the best things is really just look, this, we wanted to have a few episodes on the business of advice, just explaining what are the different types of advisors, what are they bound to, custody, etc. And today I think this is a hugely one of the most important episodes we've had on our show, because really what it breaks down is how to read what an advisor is doing for you and how to discern the signal from the noise to make sure that in addition to the trust and the personal relationship, that this is a very credible person. And you write, and an advisor is required to, on a yearly basis, update their ADV. What does ADV actually stand for? I don't even.
It doesn't really stand for anything. It's ADV because it's filed and prepared and maintained by registered investment advisors.
Oh, the
So
ADV is advi. Okay.
there
I
you go.
just
Yeah, it's not an acronym.
Wow,
And
I thought it
so,
was.
like, broker dealers have a Form BD that they file, broker dealer, Form BD. Investment advisors have the Form ADV.
I guarantee you, if I ask any advisor right now, what does ADV stand for? I don't think 95% of the people know this.
Because it's a trick question and it stands for nothing. Yeah.
All right, but it stands for nothing, but it's about everything.
Yeah.
So, in addition to that, there's one more question before we begin that comes up here. What, why is advisor, in the English language spelled with an O, and why, when you see it in legal papers and things along those lines, spelled with an E? Do you
Yeah.
know? It just
They mean the same thing. They mean exactly the same thing. So don't get bogged down in the spelling if that's something that's been tripping you up. The law that created investment advisors as an industry and where all the rules and regulations that they're subject to are found is the Investment Advisors Act of 1940. That's advisors with an ER. When a lawyer writes something, they will use the ER form more often than not because that's what the law is. When almost anybody else writes advisors, they're going to use the OR form, but they're saying the exact same thing. There's no actual distinction between advisor with an ER and an OR. It's just a preference for most people. And for lawyers, that means the ER more often than not.
Got you. No, I always find it, because then when we write in our marketing side or on our website, we always do the OR, just because, I don't know, it closely aligns with the English
Hey,
language. Yeah.
everybody has their favorite, but it makes no difference.
Okay, so then let's break down the ADV. We'll choose McLean simply because that's our firm, and we're completely transparent. And I feel better about doing that than pulling in some random firm's ADV and talking
Yeah.
about their business. So the purpose here is we're using McLean's, and we'll have it downloadable in the show notes. You can download the ADV, and it may be helpful. Just download it, and you can, as we're talking, you can kind of see it just the same, or just listen in. That'll be fine. But I don't know. I thought it'd be kind of cool to do it in that manner as well. So let's take it away, Ryan. It's your show at this point.
Yeah, and so Form ADV has multiple parts. You've got Form ADV Part 1, which an investment advisor files online. It's kind of a data entry form based on a set of questions and response options. That is something that's filed directly with whatever regulator the firm is registered with, either a state, one or more states, or the SEC. That's not the subject of this discussion. That's the ADV Part 1. There's the 2A, the disclosure brochure. That's what we're going to be focusing on here. That's really the meat and potatoes of an advisor, description of the advisor's business and fees, services, conflicts, things of that nature. There's the 2B, which is a brochure supplement. That's kind of a miniature biography of the investment advisor representatives who are going to be actually giving you the advice, the individuals of the firm who are going to be working with you. Give some information on their background, their education history, business background, their outside activities, if they have other businesses or other ventures beyond being an advisor representative, and some of their personal conflicts of interest. And then you've got ADV Part 3, which is the client relationship summary, or Form CRS, interchangeable terms there. That's a 2-page document, could be 2 or 4 pages depending on the firm. That's kind of a book report version of the disclosure brochure that we're going to be talking about here. Just very, very abbreviated discussion of the firm's business and fees and conflicts. But I think the most meaningful document is this 2A that we're going to be looking at.
Yeah, and look, I would say this. Why is there an abbreviated version of a document we're going to talk about? It's human nature, right? Look, this is an important decision. And, some people say, well, I don't like to read, or I don't like to do this, or just tell me what to do, that kind of thing. And I get that. I'm like that with certain things, right? But this is hugely important, and it's just your responsibility, as even, for your family's assets, if you seek financial advice, you need to just read this, it's one of those things. You could say, it's just boilerplate. It's not boilerplate. There's some language that you need to follow, but the reality is it'll tell you a lot about the firm in which you're entrusting your assets to, that you spent 30 plus years building. So, honestly, if you don't do it now, when?
Exactly. Like this is your shot. If you're hiring an investment advisor, this is your shot to really vet them out, feel them out, get a sense for what they stand for. And one of the best ways to do that beyond just talking to somebody is through this ADV.
Yeah, and talking is important, but it's not the end. It's not like, you know what, I like Ryan, he's a cool guy, I'm gonna go with him. No.
Yeah. A lot of cool guys out there.
Yeah.
I wouldn't trust them all with my money.
Yeah, Ryan passed the first step. Now we gotta, see him. All right. Yeah. So what do we have here? So I'm opening up the ADV.
The first thing you're going to see for almost any ADV 2A, the disclosure brochure, is the cover page. There's 18 items that all firms need to address in the ADV. Some firms need to have a 19th item if they're state registered, but we're going to focus on 18 because that's what everybody addresses. And item 1 is the cover page. And this is just giving you bare bones details. Who is the firm? McLean Asset Management Corp. Where are they located? How can I contact them? Phone number, email address, what have you. And it also gives you the date that this version of the ADV. So we're looking at the March 7th, 2023 filing for McLean here.
And a firm has to do these every year.
That's right. At least once a year.
Yeah, you're right.
Yeah. So if a firm makes a material update, they have to update it during the course of the year, but everybody has to update it at least once a year.
Okay. And so then sort of like the State of the Union address. You got to at least talk once in front of the nation, but,
exactly.
results vary. All right, so page 2.
Yep. Page 2, you're going to find the material changes. So this section is going to talk about all the material changes that took place since the last annual updating amendment that was filed. So in this case, we're talking about all the material changes that took place since March 9th, 2022, which is McLean's last annual amendment filing before this March 7th, 23 version. Won't give a lot of specifics. Usually it'll just say we updated item X to do some vague thing, but it'll at least give you an indication of where to look for what changes have taken place.
Okay. And so then there's a table of contents about the items, the 18 items that you mentioned. And then it gets into the brass taxes with item 4, where we're talking about our advisory business. Now, what are some tells? And you can obviously use McLean as an example of what the tells are there.
Yeah, and really, you're looking at a number of different things in this section. Who are the owners of this firm? MAMC is principally owned by Alex. Easy, very straightforward. Who are your primary clients? Individuals, retirement plans, trust estates. Again, very straightforward. What a lot of people are going to be interested in are what are the services you're going to offer me? And these services can come in a variety of different shapes and sizes. You may have investment management, just pure money management, either on a discretionary basis or a non-discretionary basis. Discretionary versus non-discretionary meaning, do they have to tell me before they want to do something in my account? Non-discretion means that I tell that my advisor has to call me or email me every time they want to make a trade and make sure that I'm okay with it. That's a non-discretionary engagement. Discretion, that speed bump doesn't exist. The advisor is given full discretion to do whatever they want in terms of managing and trading the account. They don't have to talk to me first. They always have to do whatever they're doing in alignment with my goals and objectives and any restrictions I want to place on their authority. But if I grant them discretion, then subject to those goals and objectives, they have full discretion to do whatever they want in pursuit of those goals and objectives.
Now, a couple of points here. Discretion, we talked about custody in the last episode. That doesn't mean we can make trades and send them to foreign accounts or anything like that. Discretion, actually, from a workflow standpoint, our firm functions with discretion. If you're a client that wanted to send us assets to manage and all of it is non-discretionary, we probably wouldn't take it, simply because the logistical hassle of calling somebody every time we rebalance a portfolio, or dividends came in and we're going to reinvest it, and dealing with sort of having to call you before we do that, like these practical kind of things, it's just not worth it from a workflow standpoint. Now, that's not to say that we don't have some assets that we don't have discretion, but that would happen if, like, let's say you bring over $1 million, right? And 50,000 of that is stock that your grandmother gave you. And you say, hey, look, there's 950,000, but this 50,000 don't touch because it means a lot to me. It's that there's a reason why it can't be touched or something like that, and we don't have discretion over those assets. That's fine. But it's very difficult, and I don't know. I know from McLean, but I don't know if from your experience with other firms, it's very difficult to manage a firm efficiently with non-discretionary only approach, because it'll just shut you down. I got to wait for Ryan to call me back to see what I do with these 20 cents of AT&T stock dividend. You know what I mean? Like, that's just...
And my hands are tied until I hear back from you. And if you're on a 2-week vacation, that means your account, can't be touched for 2 weeks unless I could somehow get a hold of you and bother you while you're away. It's one of the drawbacks of having a non-discretionary relationship. I think a lot of times retail investors are looking for a discretionary manager. I'm hiring somebody because I don't want to think about this, right? So I don't want to be called every time they want to do something in the account. And I think a lot of times, in my experience at least, non-discretionary is for one of two things: either a client who is an investment professional and has a good head for this side of the business, and they want to be involved in the decision making because they know what they're talking about. They just kind of they want this other expert to give their advice and opinions, but they want to be the final decision maker, which is fine. You may also see non-discretionary for like institutional clients because they have their own investment team that wants to review all of your recommendations ahead of time. And to the client, to the institution, that's a necessary check that they need to have in order to get comfort that the advice they're receiving is appropriate. But for the everyday investor, most of the time they want discretion because they don't want to be bothered with what's going on in the account. They just want to know it's in good hands and that they trust the person who's managing.
Yeah, and I can't stress enough. There's just some logistical admin things that it just you just kind of need it. At least that's for 95% of the folks out there. It's not necessarily, let's say there's a do-it-yourselfer, and they say, "Oh, I want an advisor, but I want to know every time a trade is made just so I can approve it." They wouldn't be a client of McLean because that's just not going to work from a standpoint of just efficiency.
And there's probably a better fit out there.
Yeah.
Not everybody fits with every firm. As great as the firm, as great as the client might
Absolutely.
That's something you need to be on the lookout for. And something I think we touched on in the last section is that we're really looking for firms that fit what we want, right? And if I don't want to be bothered, then I don't want to hire a non-discretionary firm. I want somebody who will take full discretion and take on that responsibility.
Okay, there's that. So no, that's good. So there's other services here as well that we have. You may want to.
Yeah. So we and a lot of firms will have multiple different lines of service. Most of them are not just strictly money managers. A lot of them will have financial planning, for example. So maybe they will manage assets, but maybe they'll also help you set goals. What are your retirement needs? What are do you have kids who you need to save for education? What's your tax situation like? And they can take all of that information and set up a plan, or first identify goals in the near, mid, and long term, set tangible benchmarks that they try and reach to meet those goals, and then put together an action plan of how to get to those benchmarks and ultimately reach those goals. For a lot of everyday investors, that's almost indispensable in managing the assets is knowing what you're managing for and how you're going to get there. Now that all comes from the financial plan.
Okay. And then I see referrals to outside professionals. You want to talk about that a little bit? What are some things a consumer should be asking themselves? If they find the ADV and it says referrals to outside professionals.
Yeah, who are these professionals? What are you referring outside for? In this case, it might be attorneys, accountants, insurance agents, because maybe the people at McLean or the people at the firm that you're looking for aren't licensed to engage in those services, and so they basically have to outsource those to a third party. But maybe in some instances, they outsource to a third party because it benefits them. That's what we kind of want to be on the lookout for. Are you outsourcing because you're not able to engage in this, or because it's not your area of expertise and that you're not the best person to give this sort of advice? Or are you outsourcing to this person because they give you 10% of the fees that they collect from any referrals to you? That's something you really want to be on the lookout for. And that goes not just to these referrals, but to almost any aspect of advice is where do these conflicts come up?
100%. I mean, I've seen many advisors where, we're AUM only, that kind of thing. We only get paid for services, but they refer out banking relationships, and the bank sort of kicks them out. I'm not saying that's right or wrong. They're transparent about it in their ADV, but no one reads it, And so it's one of those things that you should know this simply because you want to know what you just want to know what you're getting into. We pay a retainer, a yearly retainer to a long-term care professional, that we refer clients to, but we're not getting paid. We actually pay that person a retainer to provide advice to our clients. Why? Because it gets complicated, the long-term care rules, and we'd rather have an expert on that. We have a stable of attorneys and accountants we'll refer to, simply because, to your point, the level of advice that we give, you want to make sure you don't cross the line and you're actually providing legal advice, or you're actually providing like accounting advice, because we're not CPAs. There's a technical line that we have to follow.
Right. Yeah. If your investment advisor is drawing up a new will for you, and they're not a licensed attorney, you want to like take a step back and say, do I really want to, get this important piece of advice and this important document from somebody who's not a licensed attorney? Are they even able to give me this document? There's a lot of training that goes into being an attorney, and if you're going to get legal services, you want it to come from somebody who's authorized to do that. But more importantly, I think is the conflict. Like you said, a lot of people don't read these things, but it's so important that you do read these things, because this is where the conflicts, for the most part, this is where they're going to be disclosed. And an advisor, in order to meet their fiduciary duty, they have to give full and fair disclosure of their conflicts to you so that you can consent to them. But what they're not required to do is to actually get your literal consent to that conflict. If they disclose it to you and you don't come back and say, I don't want you to act on this conflict, then you have implicitly given your consent to that conflict, even if you never read the brochure, even if you never read this document where the conflict was disclosed. So it's really important that you read this, that you identify, pull out the conflicts, and kind of figure out where the conflicts lie for a particular firm. Because after they disclose the conflict to you, their disclosure obligations are done. As long as they can justify the advice they give as being in your best interest, then it doesn't matter whether you've actually consented to the conflict or not. You consented to it by not doing anything about it, by not restricting their authority or their advice-giving ability. And that's why it's important for you to do your homework and figure out where those conflicts are, and this is the place to do it.
So if you're looking at ours, we have here we do employer-sponsored retirement plans. We do 401k plans. Invariably, there's somebody that comes over that has a 401k, and we roll it over into an IRA rollover. There's issues there. What you're looking at our things, and again, you're a compliance attorney. What would you ask us, warts and all? I'm fine with that. What would you ask us relative to our lines of business that you would think you'd want to kind of just rule out?
Yeah. So what are you going to give to me? I have a 401k account, let's say. I have a separate brokerage account that I've just been self-directing for, the past 10 years. And then I've got, just a pile of cash that's been sitting aside that I've been saving for a rainy day, and it's been accumulating, but I haven't done anything with it. And with inflation, it's losing value every day. So I'm going to look in here and I'm going to say, well, ERISA-sponsored, or employer-sponsored, retirement plans, that doesn't really impact me. That's them. That's the McLean working with a plan. That may not be McLean working with me. And so these services that are geared towards businesses, I'm not super concerned about. I'm more concerned about what they're giving to retail investors. But then I get to like rollovers and conflicts that can arise from there. I might see that. It might catch my mind. I've got a 401k account, so maybe a rollover is right for me. Well, McLean, if McLean recommends a rollover, they're conflicted because it's going to increase their compensation. Is that a problem? Is that an issue? I at least have caught that. I've heard the term rollover. I know that I've got this account that may be subject to a rollover. It may be a good idea to do a rollover. I see these conflicts in place. But I don't have enough information to like really reach a conclusion about what McLean is going to do with that account. So that it becomes something you want to discuss further with the firm. And that's what a lot of this is going to be about. It is not, we're reaching a hard and fast conclusion based on what we see here. We're kind of issue spotting for things that I want to talk about further with the firm. Oh, you advise on rollovers? You might recommend rollovers? Is this a good idea for me? And go from there.
Yeah. No, and I think rollovers, that's going to be in everyone's ADV at this point, because that's the reality, right? If somebody has an ERISA sponsored 401k plan and you're asking them to manage those assets from there, invariably that's always a conflict, because you're asking them to give you the discretion of those assets, and
Yeah,
and the
you
business
you
benefits that come with that.
yeah, and we're going to get to this in the next item, but a lot of investment advisors are billed on what they would call an AUM fee, assets under management fee. It's a fee that is maybe 1%, to use a round number. 1% of all the managed assets per year is the fee. And so if they're not managing my 401k, but they would manage those same assets after they're rolled over into an IRA, number one, that conflicts them in giving the rollover recommendation, because the investment advisor obviously is incentivized to increase the assets that are going to be subject to the AUM fee. And number two, there are certain processes that they're going to need to walk through in order to give that advice. We don't need to get into that here, but
No, I got you. And just keep in mind, I mean, this is, why would you do that, right? Well, usually, I mean, it's getting better, but the 401k options are much more limited than what you can just get in the open market, and that's really the bottom line. It's getting better because there's such a strong attention now to fees in the 401k spot that there wasn't even 10 years ago. So, it was, those are the considerations. You just have a greater option of investment choices away from a 401k plan. So it made it an easy kind of rollover suggestion. But, they are becoming more competitive. At least I get that sense. Do you, Ryan?
I do, and I think that's almost by necessity, because if I'm in a plan and my investment options are 10 different target date mutual funds, which, in a lot of cases, that's what the plan is, and I don't get individualized advice, I don't get planning from anybody. And by the way, I'm probably paying 10 to 20 basis points a year to have an investment advisor recommend to my employer what those 10 target date funds are. Where do I get the value as a participant in that plan? It's hard to see.
No,
Whereas it's a lot easier to see where the value comes from in an IRA, where I'm not limited to 10 target date funds. I get discretionary management, perhaps. I get financial planning. I pay a little more, sure. Well, most of the time I pay a little more, but it makes sense.
There's value.
Because I
There's
get
value
more
there
for my money. Right.
Yeah, and so the point is, I mean, my takeaway is these are more potential issue spotters. Just because something is there doesn't mean that there's an issue happening. It's just if they would come up, it would come up in that realm. That's all it is. But again, it's just the whole theme is making you an informed consumer. Regardless, even if you don't pursue not to get advice, you should at least know why you should or why you shouldn't, or making sure that it fits, as opposed to just having preconceived ideas about the business of advice.
Right. And I personally, I really appreciate when firms are transparent and upfront with their conflicts. They own the fact that there are conflicts, that they can't get rid of the conflicts. It's just inherent to their business. But they're upfront about it. Hey, this conflict exists. What I don't appreciate as a consumer is firms that try and hide the ball. They may talk about things that are a conflict, but they don't tell me in plain English, this is a conflict. They rely on me to kind of reach that same conclusion on my own. That's just me, my personal opinion. I appreciate the transparency that I see in a number of firms that are just very upfront about this is a conflict, and here's what we do about it.
No, I got you. And so item 5, we go into the fees and compensation.
Yep. And so this is where you're going to see.
Go on.
You want to look for what the fees are. What service am I getting, number one? And then what are the fees for that service? So something like what you'll see here, this is very common, this fee schedule. You've got, different levels of assets that you might place under the advisor's management, and a descending asset-based fee from there, depending on what the levels of assets are. You want to make sure that the fee you're paying is something you're comfortable with. You probably don't want to pay more than like 2.5% to 3%. Those are like the absolute highest that I've seen in my career.
Is there a
in terms of
legal
financial
thing?
asset
Is there a
based.
legal thing? Like, can you get audited
The,
and the SEC says, "What are you doing charging 4% a year?" I don't
the
even know.
Yeah, so you have to charge a reasonable fee, and reasonable can vary.
Yeah,
It's
exactly.
in the eye of the beholder a lot of times. I think a lot of firms or a lot of regulators will put like 3% as the rule of thumb. That if you're paying more than 3% as an advisor, if you're charging more than 3% as an advisor, you better be prepared to justify that, because the presumption is going to be that that's an unreasonable fee.
Okay. Yeah, I didn't know if there was like a magic number that, Voldemort.
It's
People
it
don't mention it.
it's not a hard and fast thing. Like I said, it varies depending on who's looking at it, and it could, that 3% could include a whole laundry list of things that you might pay separately for with a firm that's going to charge you much lower than that.
And to be clear, McLean is
So
not charging 3%. We're just using three
no,
percent right now as a. I was just wondering what's considered a usury kind of fee.
yeah, the 3% I think you're only going to see for something like a wrap fee engagement. Wrap fee, for people who don't know what a wrap fee is, a wrap fee might be an engagement where the advisor engages in a ton of trading activity in the account, but doesn't pass along the transaction costs that are incurred for that trading activity to the client. It's something they just absorb out of their fee. And so that might be an instance where it's worthwhile to pay a little more if the advisor is going to transact very heavily in the account. Then instead of paying a $10, $20,
But
$50
that's
ticket
not even a
charge
thing
for every
anymore, right?
trade,
The way the industry
it's
has
a thing
gone,
that
that
exists. It's more rare than it was 5-10 years ago, for
just because fees
sure.
there's no trading. Effectively, trading costs are zero at this point.
For a lot of asset classes at a lot of brokers, but not all the time in all
Sure.
cases.
Okay,
Yeah.
fair enough. All right, and then you
Um,
have the fee schedule that you could see there, the AUM fee schedule, which is
Yep.
usually
You also you want to know what you're getting for that fee.
and
Also, like,
something
does
that
that fee include planning? Does that fee only money management? So on and
I
so forth.
100%. And usually the fees are they don't cascade; they're tiered. So the first million is X amount. Then from $1,001 to whatever 2.5 million, it's X amount, and so forth. It doesn't doesn't cascade. It's sort of tiered, and that's kind of the industry standard. The other thing about fees is sometimes they you can pay them in advance, in arrears, and based on
Hmm.
what valuation. You want to talk about
Right.
that real quick?
Yeah. If I'm gonna bill in advance, let's say and it's gonna give all of these details in item 5. It'll say we bill in advance, we bill in arrears, we give clients the option of either on a quarterly basis, monthly basis, whatever the case may be. And it'll also tell what the valuation date is. It's based on daily average balance during the billing period, the first day of the billing period, last day of the prior billing period. Um, there's no right or wrong for either of those things. I personally prefer paying fees in arrears, because I don't want to have to get a refund. That's one of those things. If I pay in advance to an investment advisor and I terminate the agreement with the advisor in the middle of a billing period, now I'm owed a refund for those fees that I paid in advance. And do I want to be bothered with jumping through any hoops to get a refund? Personally, no. And so I would seek an arrears billing advisor. But it makes no difference. Like, your mileage may vary. I'll say on that. You may have different preferences, or you may not
Yeah.
care about the refund.
And for
Um,
McLean, we're in advance, so I guess we lost Ryan ever becoming a client. And we do
it's not
average
a
daily. Nah, I'm kidding. And we do. Oh, we'll get you soon enough. And, no. And we do average daily balance. It just from a workflow standpoint, it's what we've chosen. And yes, there's a refund piece, but I don't know. It's just a matter of hitting a button and off it goes. So we don't. But I can see your
yeah.
point where maybe somebody gives somebody a hassle, but I don't know. I've never heard of it, but that's fine. I'm sure it happens.
You want to know these things. That's the overall point. Like, you want to know whether they're billing in advance or in arrears, and you want to be comfortable with that billing methodology. And if they're billing in arrears, you want to know what's it going to be like to get a refund. Is it just going to be sent to me? Does it say in here, you will be given a refund if you give a written request?
Yeah.
And do I have to jump through a hoop? Like, that's
and it's good. I mean, even though you think the relationship's long term, you want to know that if you need a divorce, what's the way to go about it. So that's fair. It's fair.
Stuff happens. You just want to know what's my experience going to be like.
Exactly. What other fees do you see that an advisor can charge for?
Yeah, you might see hourly fees. That's big in like the planning or in the discrete consulting context. If I only want to meet with somebody once a year for an afternoon or for a few hours, then maybe they'll charge me an hourly fee. They'll tell me, $2.50 an hour, $3.50 an hour, whatever the case may be. That's great. Let's book 2 hours. Let's book 3 hours. I know what my fee is going to be for that. You may also see fixed fees. You want me to write a plan for you? Okay, I'm going to charge you $5,000, or I'm going to charge you $10,000, depending on what like the complexity of my situation is, how involved the planning process is going to be. That's going to largely dictate the price, and it's a factor of how much time the advisor is going to have to put into constructing the plan and what they would, maybe normally charge on an hourly rate basis. But you may also, in some cases, you may see, $50,000 a year, and you'll get planning services, you'll get investment management services. There will be no asset-based fee. There's 100 different ways that these things can play out. Here we're looking at $250 to $1,000 an hour for hourly engagements, and $1,000 to $50,000 depending on scope and complexity for fixed fee engagements. But it could be really almost anything.
Yeah, I mean the caveat here that always is interesting to me. You have to put the highest possible number, even though clients on average may not be paying that much. You have to put the highest possible number that you could potentially charge. That way, it kind of doesn't restrict yourself later on, and so hence you have that. And so,
right?
Have we charged anyone a $50,000 engagement? Off the top of my head, I don't remember if we have. It's possible, but that's not like the norm, that kind of thing. But you have to kind of put a high number there just for the heck of it.
That's it. I mean, we have to put a range of fees in place. And if we don't want to limit ourselves, then we kind of have to say this is like the highest thing we might charge for somebody who has a very, very complex situation, just to give yourself that flexibility.
Ryan, when you come on board, we'll have to change this to 1,000 to 51,000. We'll have the 50,000. We'll go, but no. But it's true, right? And so you just from a business standpoint, just know that you can always go to the advisor and talk to them about, from a business standpoint, what you think your fee should be. This is not like the market in Morocco or something like that, where everything is you're negotiating. But again, know that the fees here have to be at the highest watermark. So from a compliance standpoint, so there's nothing wrong going back to the advisor and asking. If you don't ask, you never know, right?
Yeah, and this is kind of just pie in the sky hypothetical, but if you go to an advisor and their ADV says our fixed fees for this service are 10 to 20,000, and they quote you 50,000 for whatever the same service, that immediately should put up red flags for you.
Yeah.
That why do they say that this is their fee and they're doing so? It's a bait and switch, that's the initial reaction at least. And hopefully they would have a really good answer for why they quoted you that amount. But it should kind of put off the make you stop and think a little bit about why they said one thing and they're doing another.
Yeah, and I see something here. We have it written, third-party fees. What does that mean?
Yeah, so it may not always be the investment advisor who's charging you fees in an advisory relationship. We talked about having your fee or your assets at a custodian. The investment advisor may not be holding your assets. It's at a custodian. That custodian, that broker might charge their own fees. Maybe they charge an account maintenance fee, an administrative fee for having the account open. In some cases, they might charge for transaction costs for the securities transactions that take place in the account. But they charge their own fees, and those fees are set by the broker or custodian, and they're totally separate from the fees that an investment advisor might charge for you. There may be fees for pooled investment vehicles, mutual funds, and exchange traded funds. Those funds are managed by an investment advisor. And they are also held, the assets of the funds are held at broker dealers and custodians. And so those professionals have their fees that they assess to the fund in the form of, what they might call an expense ratio. Basically telling you how much of the fund's assets are eaten up by these costs that are charged by third parties. But so it's not just the investment advisor that's charging fees. It's the brokers or custodians who are holding and transacting in the assets. And it could be the assets themselves if they're pooled investment vehicles with expense ratios.
And
just other types of fees to keep in mind.
Yeah, and so we have to list that what third-party fees are. But if you read our ADV, it says at the bottom of that point that MAMC does not accept fees from the sale of securities, blah, 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 blah. So again, you have to list all these things, but, continue reading through it and you'll see where the firm specifically stands on that item. And maybe for the last point on this episode, and we can continue them, I guess it's a two-part of the ADV explanation, is the manner. And we talked about it briefly, and maybe we don't need to, but another section within 5 is the manner of payments and calculation of fees. Do you want to maybe go through that a little bit?
Yeah, and a lot of firms, McLean included, will be authorized to directly debit a fee from the client's managed account. May set off custody alarm bells for people who recall the custody conversation from previous episodes. Why is the advisor allowed to just take their money or their fee out of my account? It's because the SEC feels like there are sufficient checks in place. The custodian, the broker dealer or bank that's actually holding the assets, if the advisor is going to be able to directly debit fees from the client account, then that broker is going to be required to send the client at least quarterly statements of all the account activity that took place, so that as a client, I have enough tools in my toolbox. I've got maybe my IAA, my investment advisory agreement with the advisor. I've got my account statement showing the account value and the fee that was debited. Put all those things together, I can run the numbers and make sure that the amount that the advisor is taking out of my account aligns with the fee I agreed to pay, so that they're not taking advantage of that authority. That's why that's permissible without the advisor taking actual custody and subjecting that to a CPA exam.
Something, and I'll end it with this, something that you said sparked this in me, the point about custody that we talked about last time. The benefit of also not having custody is that you'll receive separate asset reports on a monthly basis from an independent source. So Schwab, Fidelity, or TD will send you monthly statements, right? Either by mail or email, however you choose. And then you can kind of reconcile that with what an advisor uses to show you what your statements are and things like that. So you always have that as well, which is, I think, good to have. It doesn't mean you need to Go on.
Yeah. Now, to your point, it doesn't mean you have to look at every single statement that comes through with a calculator and run numbers every month. But check in every now and then. Make sure it makes sense, that it's not totally off base. Just give it a quick once over to make sure that it aligns with what you expect it to look like from a fee debit perspective.
Yeah.
You might not get it every month. It needs to go out at least quarterly. Most custodians do it monthly, but the requirement is that it go to the client at least quarterly.
Yeah. And technically, actually, an advisor is not required to provide performance reports or anything like that. So I always think it's good just simply because it keeps the advisor on their toes. The idea is, all right, we're preaching long-term investments and then providing a quarterly report, so it kind of runs contrary. It's a bit hypocritical, but I think it's good because it shows to me that the advisor takes their business seriously, because there's an infrastructure in place that they can produce these reports. This is my example that I said last time. When it's busy at the restaurant, go to the bathrooms. If the bathrooms are clean, it's a good restaurant, right? Yep. So if your advisor is providing quarterly reports pretty, on a timely basis and the like, that's a good tell for me. I mean, I know it sounds like a low bar, but it's good,
It keeps the advisor honest, because they have to confront their actual performance every reporting period, right? Yeah. And they have to answer for it if the performance isn't what they think it should be.
And you could always reconcile that with the monthly statements from the independent custodian. Ryan, I think, we're going through the ADV part 2, whereby, number 5, and so we don't rush through the rest of them. Why don't we have a 2-parter in this one? Is that okay with you?
I'll be happy to come back.
I guess I put you on the spot with that one. What are you gonna? Yeah. All right. So we'll stop this for right now, and the ADV part 2 will be a 2-parter. How's that?
Okay.
All right. Thank you, everyone. We'll follow up next week with the rest of the stuff on the ADV. Thanks.